Hello, hello, hello. It's great to see you again, and welcome back to yet another live event where we unpack passive investing, multifamily underwriting, one step at a time. And today I will address a question that I very frequently get asked, namely, what are the different types of commercial lenders and capital providers out there? For those of you who submitted questions and topic suggestions, I really appreciate it. But before we dive in, for those who may be tuning in for the first time or perhaps don't know me, my name is Vessi Kapulian. I'm former commercial lender turned real estate investor and entrepreneur. Today, I primarily work with both family offices and their family enterprises on strategic initiatives, investments, next gen transition and planning, as well as with private investors looking to diversify their portfolios and achieve tax efficiencies, where I help connect them with well vetted cash flowing investments in apartments. I also consult a lot of private investors to help them navigate through the complexities of the deal structure and the numbers. And last but not least, for those willing to do a deeper dive and learn how to underwrite apartments from beginning to end, I have a community that comes with a self paced course to help them do just that. And lately, I released a book. I published a book, Mastering Multifamily Underwriting, to further help investors with their education, and became an Amazon bestseller. So I invite you to check it out on Amazon. So without further ado, I wanted to address the question that many of you asked or have been asking recently. And to do that, actually, I will share a slide. So let me bring it up in a second, just so you can visualize it a little bit better. And then we'll transition into the actual, let me see if I can pull it up quickly. Okay, it's not coming up. All right, so I was really hoping that I was really hoping that it would pop up, but for any reason the file is not coming up on the screen. Anyway, if you're interested, I will share with you a copy. So simply send me a DM, and I'll make sure you get that information. But there are really five main categories of lenders playing in the commercial real estate space. And I do want to clarify for a moment that I focus on apartments, so multifamily is the asset class that I'm most active in. So any references and lender types that I speak about will be in that context. So there's five of them. One is the banks, the traditional banks. Think of it as Wells Fargo, JP Morgan, Regions, etc. Those in the current environment represent roughly maybe 30 to 35% of the loans. These are your traditional lenders offering short to mid-term, typically recourse loans, and I'll get into specifics of those in a moment. And number two are the what's known as the agencies or the government-sponsored enterprises. You've probably heard about Fannie and Freddie. Those are currently represent probably roughly 40% of the market. And multifamily is one of the unique asset classes that has the privilege of getting Fannie and Freddie agency financing, which typically come with some very attractive terms beyond just the non-recourse nature. They also provide longer term amortization of 30 years, very similar to the one that you would get when you finance your primary residence. So that's a great benefit. Not all asset classes get to enjoy that because, again, they primarily focus on the residential space. Life insurance companies is the third area that they're typically probably around 5% of the total market, and they usually focus on high quality, low risk properties. Then there is also CMBS, or commercial mortgage backed securities, that they typically pool loans together and then they're sold as securities on the secondary market. Today, they're around 10 to 15% of the total universe, actually increased their share over the past couple of years. And last but not least, the remaining, call it 5% or so, are what I call private credit and funds and other capital providers that may be a little bit more flexible in terms of capital. But of course, as always, there's no free lunch for that. So let me cover just very quickly the nuances. Again, I like to keep these pop-ups brief, and if you have questions or want to dig deeper into any of those, I invite you to connect with me one-on-one, or send me a connection request. And if it's a more in-depth topic, I'm more than happy to do a follow-on pop-up live and address that to make sure we cover everything. But the first one that I mentioned, it's typically the banks. Like I said, these will be the traditional institutions that you think about. They're really best suited for properties that are stabilized or perhaps slightly transitional assets, but for the most part, assets that would cash flow on day one. You do get more, the approvals tend to be, in most cases, faster relative to some of the other areas that I'll cover in a moment. They have a little bit more flexibility when it comes to structure. You can negotiate that directly. And if you have a more expanded relationship with that bank in terms of deposit, maybe foreign exchange, or any other services that you use, it also opens the opportunity for relationship pricing. Now, a lot of these loans typically are structured on a recourse basis, meaning one would be expected to provide a personal guarantee. The leverage profile may be lower. And again, they're mostly centered around cash flow, like many of the providers. And the covenants may be a little bit stricter. So just a few things to keep in mind. Now, with the government-sponsored enterprises, again, think Fannie and Freddie. Today, they're the most active source of multifamily financing. Similar to the banks, they're best suited for stabilized properties. They're typically looking for at least 90% occupancy for the preceding 90 days. But unlike banks, they're able to structure the loans on a non-recourse basis. Their rates are very competitive. And as I briefly mentioned in the beginning, the amortizations are a little bit longer and more closely aligned with what you would get in a single family residence, which is 30 years. With the banks, right, depending on the useful life of the property and the type of property, it's typically anywhere from 20 to 25 years, right? So the terms that the agencies offer are very, very attractive. Now, there's no free lunch, as I said, so they definitely go through some very rigid underwriting. Their process could be slower, and it really depends. I think Fannie or Freddie, I always get the two mixed up, but one goes through their lender network, the other underwrites the loans directly, which also plays into the timeline and the of the overall process. But they also have more limited flexibility, right? It's very rare that you can go and renegotiate the whole credit agreement, because these are pretty much canned or fixed structures, and eventually they may repackage and sell those loans, which is also why it's not uncommon, if you're in that space, to see a frequent change in servicers, right? When the loan gets sold from one party to the other. Now, I did mention the commercial mortgage-backed securities, or CMBS, which typically they tend to pool loans together and then sell them as securities. So typically suited for larger loans, 5 million and above. They're looking for stable cash flowing assets. It's also not, because they focus on the quality of the asset. It needs to be really high quality asset in a high quality market. They're able to offer non-recourse financing, maybe slightly higher leverage, long-term fixed rates. But of course, with that come pretty steep prepayment penalties, a lot less flexibility post-closing, because again, that loan is packaged and then sold. So any modifications would create a lot of complexity, and they may not even be on the table. Complex servicing requirements. So that's important to keep in mind. I did mention life insurance companies, which is the other source. Again, very similar. They would focus on high quality assets in high quality markets. So typically, your Class A properties will likely be there. Not maybe Class B plus, but not your B minus or C plus properties. They may be able to offer longer term financing, fixed rates, non-recourse as well. But again, because ultimately they're managing proceeds of their insurance, the leverage would be very conservative. They have very limited appetite for higher risk assets, think secondary, tertiary markets, or um, value add process. And then the last tranche is the private credit and other resources. And in that other bucket, I did a whole live event and actually published an article on C-based financing. That's one type of debt. I didn't mention bridge debt, but there are a lot of bridge debt providers which are really intended for those higher touch, higher risk projects, assets that are perhaps not stabilized but need the time to get turned around. And because they're taking on more risk, the pricing there will be reflected accordingly. Not uncommon to for those bridge debt providers, for example, to require guarantees, again because they're taking on a lot more risk. And the duration of those loans will typically be shorter, anywhere from 12 months to 36 months, again depending on the nature, size of the project. In many cases, they will provide the option to extend. They'll provide 1 or 2 1-year extensions, but it's important to understand that that's an option to extend, not an obligation. And there are likely going to be additional requirements that need to be met for the lender to even want to consider the option to extend. So it's important to have those conversations up front so you understand exactly, as an operator or borrower, what you need to do or how you need to stage the investment should you feel the need down the road to request that extension option. And with private credit, again, there may be a little bit more flexibility because there is an alternative provider of capital, but in exchange, there will be additional fees in the structure. Of course, pricing would be higher because they are taking on a little bit more risk relative to a traditional credit provider for some of those higher touch projects. And in today's environment, a lot of the activity, right, as deals are coming due, operators have to make the decision: do I sell? Do I exercise the extension option? Do I refinance? So in some cases where the lender is unable or unwilling to renew the loan or extend the loan, that's where some of these alternative sources of capital have been stepping in. So I hope you found this helpful, and let me know if what questions you have. Happy to address them one-on-one. I typically pop up every Thursday, but on occasion I have to reshuffle the schedule due to travel or holiday and other commitments. So I hope to see you at the next event. And if you'd like to learn more about passive investing and specifically evaluating deals, I invite you to take a look at my newly published book, Mastering Multifamily Underwriting: 5 Steps to Confident, Risk Smart Apartment Investing. And alternatively, if you just want to connect one-on-one and have a conversation, the easiest way is to connect with me on LinkedIn. which is where I'm most active on. And if you're simply looking for educational content and want to enjoy it maybe a little bit more passively, I also have a ton of educational resources on my YouTube channel under Dream, Believe, Achieve Real Estate, as well as on my web page dbacapitalgroup.com for passive investing, or masteringmultifamilyunderwriting.com when it comes to underwriting. With that, I wish you a beautiful day, beautiful weekend, and I will see you next week. Actually, next week I'm traveling, but maybe the week after. And so I wish you a beautiful weekend, and I'll see you in 2 weeks.